I called my wife an idiot when she told me to sell Alibaba stock at $220 for a small loss. What do I do now? In this video, we're going to see how this guy has lost over $100,000 just because he refused to listen to his wife. Not that his wife is a stock market genius, but we're going to use this as a learning lesson for all of us investors. The interesting thing is that if this investor had followed a certain set of rules, he would instead have made a profit of over $100,000. So today in this video, we're going to first look into all of the misguided decisions that have led to this $100,000 loss. And I'll also break down the 3 dangerous mistakes that tanked this portfolio. And after that, I will reveal 3 simple strategies that this investor should have taken so that he could have made a profit of $100,000 instead of making a loss of $100,000. So whether you're a seasoned investor or you're just starting out in your stock market journey, this video is going to educate you. So make sure you watch till the end of the video so that you understand how to avoid these costly errors because you don't want to lose your hard-earned money. And at the same time, you're going to learn how to make a lot of profits in your portfolio. So the great investors are not really those that are trading the whole time. They just know. The first problem that this guy has in his portfolio is that he's focusing on growth stocks, but he's not getting, if you want to get the best of the best growth stocks in the stock market, which is the 1% of the stocks, these are the main 3 criteria that you should know. You should never buy stocks that are way off their all-time highs. Because when a stock has crashed this much, there's so many angry buyers up here waiting to sell because and this is another big mistake that a lot of investors and traders do. Before we move forward, I want to share with you a newsletter that we're running on this channel. So this newsletter will teach you how to trade and invest. We do all the research for you and save you over 20 hours of research per week. We give you precise entry and exit signals for stocks and also included free lessons and simple lessons on how to trade and invest profitably. And we do this by focusing on the top 1% of stocks. Of course, this year we had a lot of great winners. Some of the best winners this year have been NVDA, which created 180%. As you can see in the chart, NVIDIA broke out around $50 at that time. You can see the labels on the chart, and these are the lessons that you would be learning from the newsletter. SMCI did something similar and actually returned 240%. Of course, there was a very big base. We teach you all of this in the newsletter. It broke out in around January, and then you could have made 230% return on your money. There is Appfolio. So here, this stock had 2 plays this year. There was a 60% play earlier in the year from Feb. And then recently, there was also an alert in the newsletter where we told people to buy it around $88. And now it's already at $127 for a 50% gain. There is HIMS, which was an earnings play. And here we managed to get 90% in just 3 weeks. So of course, the alerts are not coming out every day, but every week you'll be getting alerts. If you want to sign up for this newsletter, go to my YouTube channel, click the link in the video description or on the channel, and then you'll be led to the Profit Punch report, sign up for the newsletter, and get all of this for free. So I did some work and I looked into this guy's portfolio, and then I calculated where he could have entered this stock. So Alibaba, he probably entered it around $213. Disney, he entered it around $86. The stock is now $95 and he made a profit of about $800. DKNG, which is a DraftKings stock, he entered it at $42 and is now $38. So he made a loss of $781. Every stock in this portfolio, I am seeing huge mistakes, and I'm going to show you how you can avoid those later in the video. EGLXF, whenever you see stocks that have at least these very long names and normally OTC stocks, it was a $700 loss. He probably lost all of his money because that's when he actually put in around $800. NEO, Palantir, you can see he's losing over $40,000 on those stocks for a total loss of $104,000. And this guy actually invested $178,000. Now, the first thing I want to say is that not a lot of people have $178,000 saved up. Congratulations to this guy and his family for being able to save that amount of money. Before we look into his mistakes, let's look into some of the interesting comments. Someone said that is a lot of tax loss harvesting. So if you don't know this and you're a beginner in the stock market, once you lose $10,000 this year, then you can write off this loss next year. That's why you see a lot of hedge fund managers trying to sell off their losses so that they can include them in their tax reports so that they're not taxed on their capital gains. And someone says that you could have a headless chicken predict a solid stock. So that's a fact about the stock market too that a lot of people don't know. When the stock market is going up, if you got a monkey from the forest and told it to pick for you 5 great stocks, it probably has a very good chance of making money. So the great investors are not really those that are trading the whole time. They just know when to be in the market. The first problem that this guy has in his portfolio is that he's focusing on growth stocks, but is not getting the best of the growth stocks. Now, the problem with growth stocks is that they go up a lot. So we could see that in DraftKings, DKNG, and Palantir and NEO, they go up a lot, but when they're crashing, they're the ones which crash a lot as well. But if you want to get the best of the best growth stocks in the stock market, which is the 1% of the stocks, these are the main 3 criteria that you should know. The stock must have super earnings per share growth, EPS, earnings per share growth. So what is the super earnings per share growth? You want to see a quarterly growth year over year, which is above 50% in the last 2 quarters, or you want to see above 30% in the last 3 quarters, ideally in the last 4 quarters. For super revenue growth, so a company that is bringing in a lot of revenue, that means it probably has a very good product. It's selling a lot of its product. So that means the company is likely to be making a lot of profit. So you want to look for an average revenue growth of about 15% growth year over year in the last 4 quarters. Or if you see something like 20% growth year over year in the last 2 quarters, that is also great. The third thing that really shows that a stock is a great growth stock is a return on equity, which is 15% and above. Some investors use 17% and above, but I use 15% and above. So if a stock has these 3 criteria, then it is probably a very good growth stock. And let me show you a very good example. So here we have the weekly chart of Alibaba, which is a stock in his portfolio. Oops. So let me show you a good example of what type of growth stocks that you need to be focusing on. So here we can see the guy has Alibaba stock. Alibaba stock is crashing. This is a mistake that this guy did. You should never buy stocks that are way off their all-time highs. Because when the stock has crashed this much, there's so many angry buyers up here waiting to sell because they made their losses. For example, this guy who bought it at $213, like in our example, and the stock is currently at $107. If this stock comes back up here, he wants to sell it, and that normally makes the stock go down. But we have the weekly chart on this side, and then here we have the daily chart. This is the revenue growth table that I was trying to tell you about. This earnings per share, year-over-year growth. You can see that revenue, net margin, return on equity is down here. So this is not a good stock, but a good stock for this year was up 11. So you can see how much profit this stock has made for investors. You can see its year over year is super. Anything above 100% is amazing. The revenue is growing way above the numbers I gave you. I told you 15% over the last 4 quarters. This has been killing it. And as a result, you can see that this year it went from $44 and it has gone up 190%. So instead of being like an Alibaba stock, you could have been in something like this. Another bad stock that this guy had is NEO. So you can see the growth is not the best. Return on equity is negative 85. That means the stock is making losses. Earnings per share growth, we do not see an average of 30% over the last 4 quarters. So it's a no-go. Revenue, I can see the revenue is up and down, so it's not so trustworthy. And the stock is also very off its all-time high. So this is not a good investment stock. You can see that. Compare this to something like NVDA. You can see the earnings are super. And what did that do to the stock? It went from $50 to $141. So you can see the results of what I'm trying to tell you. That's the first thing this guy got wrong and he should have fixed. He does not have good growth stocks. He does not have super stocks because there are over 10,000 stocks in the stock market. Why don't you focus on the top 1%? Another thing is that great traders always cut their losses short. This is another huge mistake. So in this particular example, you can see that the guy refused to listen to his wife. His wife told him, please sell Alibaba at $220 for a small loss. But the guy kept on holding. And this is another big mistake that a lot of investors and traders do. They keep holding onto huge losses. So here in the example, I show you 2 traders. One is profitable, one is not. And the interesting thing is that the profitable trader has smaller gains. So while he makes only 2%, the trader with losses makes around 5%, 10%, 15%. So this guy, the profitable trader, his biggest gain is only 3%, which is quite interesting. The trader with losses, on the other hand, He has very huge wins, but also very big losses. And this is a very big mistake. So we can see profitable trader makes 2%, loses 1%, makes only 3%, loses 0.5%, because he's always cutting his losses short, gains 2.5%. And at the end, you can see the guy has gotten a 10% return over 10 trades. But the trader with losses, since he's not cutting his losses short, he keeps losing a huge amount of his account. So the first trade, he loses 5%, then 10%, then gets 5% and loses 15%. He's not cutting his losses short. Then he loses another 5% and gets 10% and loses 20%. And at the end, you can see he ends up with 29% loss, despite the fact that he had bigger swings up. But the problem is that he had bigger swings down. Now, let's see how this guy could have actually saved his portfolio. So here I attempt to save this guy's portfolio, right? So I found a stock in his portfolio and I found alternative stocks in that industry that were really super growth stocks and they're doing very well. So in the stock market, every stock is in an industry. Alibaba is in a certain industry. Disney is in the entertainment industry. NIO is in the car industry. Palantir is in the technology industry. Whenever you find stocks, you want to focus on the best stocks in the industry. If you focus on the second best or third best, it doesn't make sense. You should always be invested in the best stocks. So what I do here in this table is that I find a stock that it chose, and then I give you the three alternatives of the three best stocks in those sectors, or the two best stocks. So we can see is Alibaba, by the time I recorded this video, had a 9% return for his profit for the year. But the alternatives had 31% average. Chewy had 23%, Melly had 32%, Coupang had 38%. So if you had chosen any of these stocks, you would have likely made around 31%. So at Disney, in the entertainment sector, we tried to find alternatives. It did around 1% this year. But if you chose any of the other two stocks in this industry that were looking great, and the super growth stocks like CNK and Netflix, which averaged around 72%, this guy would have made much more money. E.g. LXF. Now, this is a very bad company. If I show you this company, it is actually, the company is crashing. The revenue is only 11 million. Why are you buying a company with revenue of 11 million, yet there are companies with revenues of billions, right? This is because he is gambling. He is hoping that it can go up 100x. Now, this is possible, but it's very rare. So it's always better to stay in the best companies in the sector. So you can see this was not a good company. If we go back and we look at LBD, ANF, which are in the same industry, you can see that these companies, good growth. Kavana didn't have the best return on equity, but its earnings per share growth is really amazing. BLBD has great return on equity, revenue, and you see what it did this year. It went up for a maximum of 188%. So focus on these really good stocks if you really want to make money. Which other company? Race. Okay, let's see Race. Good earnings, as you can see, the company did go up as well. So let's see how much it did this year. Went up a maximum of about 60%. So we can see that we could have saved this guy's portfolio by investing in those alternative stocks. Palantir, he made a good choice on this one. I think it was a gambling play. So he made a good choice by mistake. It has gone up 85% and it is actually a super growth stock. That is the only stock in this portfolio that was nice. You can see the return on equity is okay. It's not the 17% that we like, but the earnings per share growth is crazy. The revenue growth is amazing. So this company, as you can see, it has gone up a lot this year, over 100%, that's for sure. 114%, around that. So this, he made a good choice, right? So currently, Palantir, he's enjoying those profits. But if you had chosen any other stock in the sector, he would have gotten a smaller profit, of course, 45%. But if we look at the averages of the alternatives, he could have gotten an average of 67% versus his portfolio average of negative 2%. So a difference of negative 69 or negative 70%. You should always choose the best stocks in the sector. I hope this teaches you something. And of course, one other thing is that if you sign up for my newsletter, you will get the ultimate earnings strategy. That is the one that helped us get about a 90% return on HIMS in just 3 weeks. I hope you enjoyed this video and I hope you learned something new. May the markets be with you.